Hey, Michael, thanks for taking the time out today to chat with us.
Thanks for having me up, Peter. How are you doing today?
I'm good. How are you?
Doing well. A little rainy
Good.
here in Dallas, but it's about to be hot, so looking forward to a nice little cool day.
Yeah, get some warmer weather. Yeah, that's what you mentioned jumping on. How's the weather been, since that storm?
It's been almost 3 months now since Snowvid here in Texas, so we're still, honestly, believe it or not, we're still kind of cleaning up a little bit from it.
Yeah.
Pretty crazy. We got most of the buildings back on board, but the landscaping just got smoked out here. So
Oh,
trying to
I
get
bet.
some of the dead stuff out and plant new stuff. It's been quite a challenge, to be honest with you.
Oh man, yeah, I've heard some bad stories, and the mixture of, okay, decent stories with people, going through that weather. So glad that you guys were okay and safe. Um, so so as we jump in here, I kind of want to get a background, you being in Texas. Let's start before that, before you started the company and everything, and really let's start from ground one, ground zero, and go into, where you're at today.
Yeah, Michael Becker, so based here in Dallas, Texas, as we're kind of chit-chatting there before we got into the intro, but I'm a longtime commercial real estate lender. That's kind of where I got my background professionally, how we got into the business, and about a decade ago or so, started transitioning over into real estate, and about 8 years ago, kind of transitioned into multifamily. So as we kind of talked today, we've done 12,000 units. We own about 6,600 units today. I've sold, 4,000 or 5,000 of them. And so all based in Texas. So I'm based in Dallas-Fort Worth. My company's SPI Advisory. My business partner, Sean's based in Austin. Those are kind of the two primary markets that we focus on. Most of our stuff's up in Dallas-Fort Worth. Have a pretty good sized portfolio in Austin. And we're just now kind of entering into San Antonio. Got our first two deals working right down there right now. So that's about an hour and a half south of Austin. So it's kind of a natural extension and growth of our company. So it's been a pretty good run. When we first started out, we did a lot of workforce housing. So I think kind of like 1960s or 1970s kind of for year construction. Transition, did a lot of kind of B class. So think like 1980s, generally speaking, kind of for year construction. And most of what we own today, what we focus on is anywhere from A to A minus. So kind of 20 years or younger, kind of early 2000s all the way to brand new construction. That's the predominance of kind of what we focus on in the major markets, excluding Houston and Texas.
Okay. So getting back to, where you used to lend and stuff like that, did that really help you, jumping into multifamily? Did that be able to, did that give you some good foundation? So when you're looking at deals and everything like that, you can kind of, have more bearings than it would just coming in fresh.
Yeah, I think of my time as a banker, it was great. I got paid to get a really good education. A lot of people have to pay to get this education, but I was 10 to 15 years kind of in the banking business. And the last, I guess 7 or 8 or 9, I guess really were, or maybe even a decade between the credit department when I kind of got out of college into being a loan producer and originating commercial real estate loans. In the middle of all that, to 2008 through about 2000 or early 2010, I got a lot of problem loan workout experience on top of that, kind of seeing all these deals that were made in 04, 05, 06, and kind of how they went bad and how not all the stuff not to do really. And then kind of coming out of that and really got a lot of repetition. So it was really a great foundation. A lot of people that get into the out of being a vendor and into being multifamily owners and sponsors, usually either come out of working for private equity firms. That's a big thing. You see some people that were bankers that kind of get into it. It's a little tougher because it's a little bit more conservative way background. And then you see brokers kind of transition over. So of the vendors that kind of break into the ownership, I was kind of probably the tougher route coming out of the banking side, just kind of having the conservative nature and being risk averse and trying to, actually go out and take risk with imperfect information is not always the easiest thing for a banker, but that was a great education and wouldn't give it up for the world.
Yeah. So you're a banker 10 to 15 years, and then the transition of going into, getting into multifamily, what was the catalyst to get you there?
I started out in 2010, 2011 of our first deals. We really started with like a lot of people do in smaller single family space. And I ended up doing 16 rent houses, but the first deal I did was a 3-bed, 2-bath house and paid 75,000 for it, put 10 or 15,000 renovations in it and leased it out for like $1,100 a month. That's kind of how I got my start, buying a bunch of that foreclosures and the stress stuff coming out of the Great Recession. And through that process, realized it just wasn't very scalable. And then 2013, we bought our first multifamily deal and it kind of went off for the races, sold all the small stuff and transitioned over. So it was really, helpful kind of having the banking background. And then I started a little bit small, got some confidence up, and then decided that wasn't scalable. I was ready to kind of make this a full-time thing and scale. So we ended up doing 4 deals while I still was employed at the bank. So we did 4 deals, about 800 units in about 6 or 7 months, kind of right out of the gate, and really got kind of the proof of concept and really got my reputation in the marketplace. I was pretty well known being a banker and was relatively prominent in the multifamily space in Dallas. And I needed to get the perception of myself from being a banker to a principal. And I found it's pretty easy to do that. You just got to do a deal, and then everyone thinks of you that way. So little tongue in cheek is, that first deal is pretty hard, but once you kind of get over that, then you got to prove to yourself and the marketplace that you get it done and they should take you seriously. And that's kind of what I did while I was employed. And then after we did that, quit the job and been off to the races. Like I said, 50 something deals later, about 12,000 units later, kind of where you're sitting there talking to you today.
Yeah. I mean, that's interesting, especially, making that one deal and then all of a sudden everybody's like, all right, this guy's a player. He's able to, be able to handle that type of stuff. So going into that first deal, it sounded like you potentially had some partners set up too going into that deal, or is this something solo?
Yep. Nope. So I met my now business partner, Sean, when I was working at the bank. He was working for a broker out of Los Angeles that would help high net worth individuals from LA and Orange County buy properties in Texas. I made a loan to one of their clients, and I go out to meet the client on an airplane. I meet my now partner, Sean. And so he's a few years younger than me. And so I was putting all these deals together and kind of in the background, really sharp guy. And kind of through that process, we both kind of realized that, sick of making the bank money, and he was sick of making his boss money, and let's go out and kind of do these deals on our own. So we ended up partnering up with the first 4 deals. 3 of the first 4 deals was one equity partner, this really high net worth guy who's kind of put, a couple $1 million in 3 deals each. Yeah. And then we had a group of like 3 or 4 buddies that kind of pulled their money and did the 4th deal with them, all clients of his. Yeah. So I was really kind of the guy, the boots on the ground, experience, a little bit of the guy in Texas that can actually get, run and operate and manage and oversee these deals. The money was out of California. And then once we kind of got those first 4 deals done, we transitioned over and did kind of similar to what we do today, which is like syndication style. We'll go out and get a bunch of unrelated people. So the first equity raise we did was 1.8 million. I think we had about 13 or 14 people in that deal. Okay. And, one of the last deals we did was 27 million, and we had 160 people in that deal or something like that. So it's kind of taking something on a small scale and just scaled it up.
Yeah, for sure. So let's talk about from like the small, when I say small deals, like the deal that you did 2013, and then the 4 that you did versus today, doing it with, 100 plus people that are in a fund. What's different operationally? And then what's different for you, as a business owner, things to think about, especially if someone's, coming up, trying to do the same thing as you or looking to invest with you?
The first couple of deals we did, we took a smaller piece of the pie. Really, I was focused on getting a track record and growing. It wasn't so much. I wanted to make sure I did good deals. I returned money. It was profitable, and kind of got a track record and really just used that. I viewed that as like the foundation I was going to build my kind of career from, and I was really intentional about it. And so it was a little bit different on those first 4 deals. But the first syndication we did, we were a lot less efficient. The deals were unbelievable back then. I mean, you'd buy deals in north of an 8 cap that had a bunch of upside and rents, and could build back water and sewer and things like that. So you had 30-40% upside in income, and you're buying them north of an 8 cap, and it was much easier to buy deals from that standpoint, but it was much harder to attract capital and get good favorable debt terms because we're still kind of on this kind of the early part coming out of the Great Recession. So there's still quite a bit of fear in the marketplace that maybe we slip right back into where we were a couple of years prior. So to kind of source equity was actually a lot harder back then than what it is today, where there's a lot more awareness from shows like yours, or I'm the co-host of the Old Capital Real Estate Investing Podcast. Been doing that for 6 or 7 years, and there's numerous podcasts out there and meetup groups and mentors and all these different programs out there. So the awareness of the space is so much greater today than what it was back then, and the technology is so much greater that the first deal we did, we'd had to raise 13, 14 investors, and I probably had 25 calls at one at a time to get those 13 people to say yes. And I would spend an hour with each one of them. And now we'll just do like a webinar and, and then have all these people kind of race to get their money in. And back then we'd send paperwork over, they'd hand fill it out, scan it and email it back. And now we have an online portal where you kind of fill it out, and super easy and much more efficient today to raise 20 something million than it was 2 million back then. So the industry and the awareness of the industry has really matured quite a bit in the time I've been in the space. So certain respects it's easier, and certain respects it's harder. But the first deal we bought was I think 3.8 million for 120 units, so I got 31,000 a unit. And that same deal today is probably worth 105,000 unit. We sold it for 55 or 57,000 unit. 2-3 years later, and it's probably almost doubled since the time we sold it. So, it's amazing to see the valuations, and the cap rates were 8.5, and now they're, in the 4s. So it's just amazing to kind of see the growth of the time I've been in the business, the growth of the industry.
Yeah, for sure. You made a little while ago, you made mention of, you were just, done working at your job and stuff like that. And this was something that excited you and got you, really, enthusiastic about jumping into real estate investing. How was it, the transition? I know you had, a few deals on your belt before you moved, you actually took that leap. But talk to those people that are, maybe back in your shoes, now, and they're looking to do that. How easy was that for you after you got some deals done? And would you have, in retrospect, done it if you didn't have any deals and you just said, hey, I'm out?
Yeah, it's always easier with a little bit of hindsight behind you, right? But it's nerve-wracking and scary when you're, married, a couple kids, your wife doesn't work, got a mortgage and car payments and things like that, to go from, a nice secure job with a pretty good income to zero, right? So it's a little nerve-wracking, but I think it was, for me, it made sense, and it was like kind of incremental baby steps, starting with the smaller single-family stuff, and then being successful there and getting a kind of secondary income sources from those houses, and then doing the larger scale deals where, it's kind of just by nature was the right thing for me to do, just because I got the ability to get confidence. I don't think, obviously, the benefit of hindsight, I could have just jumped right in it, probably made more money if I started 2 years earlier. I would have been a lot richer than I am today if I just would have jumped in 2 years, especially though that specific 2 year period. I mean, the price was even lower. But I wouldn't have had the confidence to go out and do it. So I don't have too many regrets, but I mean, I think everyone's a little bit different. So whatever your unique situation is, and that's one thing I kind of realized in this business, Peter, everyone, that's a completely unfair business. A lot of this is who what chips you can trade. Me having, a decade plus of professional background in this really shortcutted my learning curve and my ability. And I had a lot of connections and network within the Dallas-Fort Worth multifamily community. They just all knew me as a banker, and I need to get from being a banker to a principal. But I had those established relationships. And if you're coming in cold and you're an engineer, you don't have that I had. But maybe you're 45 years old versus being in your mid 30s, and maybe you got $1 million in the bank like I didn't have at the time. So if you have money, you have experience, you got a professional background, those are things that you have an advantage over someone that doesn't. So what I think the most important thing, though, is that's a complete meritocracy in a lot of this. Either you do the deal or you can't. So you just need to be real about what you have, what resources you have at place, what connections you have, and then your work ethic and how well and how much your risk tolerance really is, and kind of start with what you have and start building upon that. It's kind of like a puzzle. You get some pieces of the puzzle, you got to get the other pieces of the puzzle. And when you kind of put them all together, the picture becomes clear, and you can do the deal. So that starts by being very self-aware and what I have, what am I lacking, and what I need to do the deal. I need to go find from somebody else. You don't have to have everything yourself. You can find an equity partner. You can find management companies. You got lenders. You got lawyers. You got vendors. I mean, you can cobble together this and kind of be a team when you're doing these deals. You don't have to be kind of the lone ranger and do everything on your own.
Yeah. Yeah. So, back then I would assume, 13, 14, probably like a lot more deals versus there are today. And it may be, well, obviously, the economy's been great, but two, how have you guys been able to stick out, between the competition where, you go into a deal to win a deal? How have you guys been able to build that rapport so you can actually capture that deal versus, missing out on multiple deals?
Yeah, I mean, it was, like I said, it was easier in certain respects. I mean, certainly with the benefit of hindsight, it was much better buying 8 cap with 30% upside income than some of these deals today that are 4 caps and you're having to overpay on your current valuation to capture some upside. But that's easy to say today, and it was not quite as easy, 8-9 years ago. That's one aspect of it. Certainly those deals, getting in and out of these deals and hitting, tripling your money in 2 years and doing that a dozen times or so certainly makes your reputation and career. And part of that is I think we did a good job and we bought right and managed well and did good renovations. And part of that, cap rates compressing 200 to 300 basis points certainly makes me look smarter than I probably am. So try to be self-aware that part of that was me and part of that was the market. It wasn't just my genius, But, with that said, I saw the opportunity and I took action where a lot of other people didn't, that are my same age that maybe saw it but couldn't actually go pull the trigger. So part of that's kind of risk tolerance. To your point on how do you continue to do deals today when the environment's a little bit more expensive than what it was a few years ago? I'm really focusing, like I said, on 3 of the 4 majors in Texas and looking at Texas. I mean, we got unbelievable population and demographic growth and everything's really favorable here. And a lot of these trends that have been going on the last 20 years are, accelerating at this kind of current market is what it feels like. The corporate reloads, population immigration, all those things are, accelerating in real time. And so there's a good reason why people are paying lower cap rates today than what they were a few years ago. The market is perceived to be a lot stronger, and it is a lot stronger in a lot of the overall metrics. Well, we just saw the numbers for the 2020 census in Dallas-Fort Worth metropolitan area grew by 1.4 million people in the last from 2010 through 2020. I mean, think about that. I mean, that's like, probably what is that, like the city of Charlotte, almost. I mean, it's a pretty major population base kind of dropped right on top of Dallas-Fort Worth. I mean, that's pretty major growth. And so we have a lot of people moving here that's, making the housing demand really strong. And now we're starting to see a lot of these people that had previously kind of overlooked some of the flyover states like Texas that focused on coastal markets. All the institutional foreign capital are now starting to come to Dallas and Austin and Atlanta and Phoenix and places like that. So we're seeing, more and more capital kind of flood here, and our overall performance are really strong, and the future prospects are great. And, kind of real time second quarter 2021, I mean, we're starting to see some pretty strong rental rate growth in real time. My crystal ball is we're going to see between 6 to 8% rent growth in Dallas-Fort Worth and Austin in 2021 when it's all said and done. So you start throwing kind of 8% rent growth on this stuff. I mean, geez, these deals are, I think the future, is very bright in these types of markets. And I think we got a lot of runway before we kind of hit a ceiling on valuation. So I think, it is up quite a bit from where I started, but I still think we got a long way to go. And, it's a world of bad options. So if you don't put your money in this, you got to put your money in the stock market. You got to put your money in bonds. You got to put your money in crypto or whatever. I mean, stuff that didn't even exist a decade ago. Now it's like the hottest thing. And so, it's a world of bad options. So just because if you don't put your money here, it can't just go and hide. It's got to go somewhere else. So relatively speaking, I think it's a pretty attractive space.
Yeah, for sure. No, I agree. And so we'll transition to talking about, building your team. You both built a team fairly, quickly in your, younger years of investing and raising capital. How imperative is that? And also on top of how imperative it is, how quickly do you need to, let's say there's, some some individual on the team that isn't performing properly, how quickly have you been able to, see that and maneuver or have a conversation with that person?
Yeah, when you start out, at least the way we did it, we've always used third-party management. So there we, have various team members. We got team members internally that are employees, and then we got kind of trusted vendors like management companies, lawyers, accountants, things like that. So on the third-party side, I mean, we started with one of my buddies, property management firm, a little bit smaller, and they weren't performing as well as we should, and we did really well in spite of them because the market was strong. So we transitioned over to a larger kind of mid-sized firm and really grew with this other firm. And that's been a great move. And we kind of did the same thing with the lawyer, same thing with the accountant, starting off kind of with sole practitioners, not knowing how big we're going to get. Then all of a sudden you start becoming a big company. And, one day my accountant, who's relatively young, he had a little minor stroke and he's perfectly fine now, but like kind of was like a wake up call. Like he's a sole practitioner. If he goes down, like I got a problem, we need to get bigger and some bench strength within the vendor pool. So that was something that we made an intentional decision to get a little bit bigger, if they cost a little bit more money, was important to us to not have like a fatal flaw within the system. We needed some redundancy. And then within the team, start out and, you do a little bit of everything, right? You do the $10 hour task and you do the $1,000 task, kind of everything in between. And then once you get a couple of deals under your belt, you get some, asset management fee income coming in and some of this little bit of money in the bank, that's when you start trying to take off some of these lower value tasks off of your plate, put them onto like an assistant and then, get operational people. And then, now we're, relatively, built out. We got, asset management, we got operations, we got analysts, we got someone that helps kind of runs transactions. We got someone that coordinates all the tax returns, so we started building out just various team members. And, along the way we had, some people that didn't quite work out. So we've had to upgrade some talent. Either they left on their own or unfortunately we had to let one or two go along the way as well and get a little bit higher quality staff. And, it's just kind of a paradigm shift though, when you grow up without having any money and you're trying to do everything on the cheap and you start getting into this, to spend a bunch of money for a headhunter or recruiter to go out, pay them, 25-30% of a base salary or someone that might make $100,000 a year to get the right talent in the place. I mean, that's kind of a hard pill to swallow.
Yeah.
When you have that kind of mindset, my father fixed appliances for a living and my mother was a school secretary. So, pay someone $30,000 in a fee just to hire an employee. I mean, that's crazy from my old mindset, but where you get today, that's the best money spent because we're going to find the right employee and that employee's efforts are going to make me a lot of money because I can leverage their efforts and more and more productivity and do more and bigger deals. So it's just kind of a mentality shift when you're coming from being employee to being the entrepreneur and employer, and it's been a gradual shift over time for me. It was you're not born knowing how to do any of this stuff and how to scale and grow a company. I was just a guy that did a lot of deals, and all of a sudden you got to become a company and you got a lot of responsibility. And that's been kind of the more complicated side of the business than actually just doing deals. I always did deals as a banker. It's just how do you manage all the stuff and the 1,400 K1s I did last year and all that kind of stuff.
Yeah. Well, so, speaking of that back end for you, like, CPAs and syndication attorneys and stuff like that, for you, when you were coming up, finding a syndication attorney, was that something easy, pretty, especially in your business and your line of work, was it fairly easy to find that person that was going to fit right for your company, or did it take, a couple of people where you had to kind of figure out what's going to ebbs and flows with you guys versus somebody else?
Yeah, the syndication part wasn't too terrible. I mean, you find a securities lawyer, and and then a lot of the real estate firms are like your business lawyer, your real estate lawyer can usually, if they're a little bit larger firm, they have kind of a securities practice within the same firm. But we tend to use a separate securities lawyer. That's all they do. And then we have our real estate lawyer who does like the transactional side, the contract work, the lender work, et cetera. And we have a tax lawyer that kind of helps with, complex tax matters on top of the CPA that does, all the kind of base level accounting. So, I don't even know we spend a year on professional fees. So you got to have all these people. And if you do enough transactions, then you're going to have to probably get a litigation attorney because you're going to have some sort of conflict along the way, or your tenant's going to sue you for something, or you got a contract dispute if you do enough deals. Eventually, something you get across with somebody. So then you got to kind of layer that in. So for us to get to a little bit bigger firm that had various various practices within their firm, so we they have a litigation department in the law firm. They have employment law, so if you have employees, they get employee contracts and things like that. So you just do enough transactions in business. I have a little lot of sayings, but one of the things I say, if you own enough apartments, three things are going to happen to you. People will die on your property, your tenants will sue you, and there'll be fires, right? So if you don't want to deal with those three things, you shouldn't own a lot of apartments. So you just need to kind of scale up. You got insurance, you got property management, you got proper professional proper legal protocols and procedures in place, and then so you just got stuff to kind of mitigate a lot of this. And the more deals you do, the more stuff's going to come across your plate that you don't really quite think about when you're getting into it. So having the right professionals, and maybe going with a little bit bigger firm that's got different lines of areas where they practice, that has been helpful for me, at least, not having to go establish new relationships with a bunch of different law firms.
Yeah. So speaking of, just being in any type of, industry like your own, and getting investors involved, have you experienced a lot of situations where, or maybe a few situations where people say, hey, Michael, I actually put, 200,000 into this, and I thought, or I wanted to get it out sooner. Can I take my money? And how do those, if it does happen,
Sure.
Even though they signed a contract, how do those get mitigated? Yeah,
that happens all the time too, right? So you can't do. We have 1,000 unique people have given us money over the years, and a lot of those are repeat. Like I said, we did about 1,400 K1s last year. We'll probably do 1,800 K1s when we do 2021 tax returns. So people get divorced, they die, all that stuff happens, right? We can do enough transactions. So the way these agreements are written, it's an illiquid investment, and they can't get their money back. It's not market. There's not an open market for it, right? So there's various provisions within your company agreements on how they go buy it out, et cetera. So fortunately, anyone that's ever wanted out, we've been able to kind of internally buy them out. And that comes with having a little bit of money and going full cycle on these deals, and you're not kind of living hand to mouth. So that's one of the things I think some of the people that invest in some of these deals, they don't quite take into account. They see like this transaction compared to that transaction, and they don't kind of fully think about kind of all the inherent risks that are different between the two different transactions. Whether it's deal risk where this is a 1960s deal and then the hood, and it's got a bunch of collection issues and a bunch of deferred maintenance and upgrades, and you got to go upgrade all these units to go get this higher rents, and that's a 15% internal rate of return. And compare it to like a brand new construction deal that's fully stabilized, that's maybe 2 years old, that's maybe a 13.5% IRR, but the inherent risk between those two transactions are completely different on the risk profile. So you should be getting higher potential returns on something that's maybe a little bit riskier. And it's kind of the same thing with the sponsor base. So if you're going with like, everyone starts from zero and does their first deal, so there's nothing necessarily wrong with going with a less experienced sponsor, but just know that person doesn't have that much money. If you need to get your money out, they likely don't have the ability to buy you out, so you're kind of stuck into the deal. So where if you go with a group that's a little bit more well-heeled or a little bit more established, they probably just give you your money back, take over your interest, and you can kind of move on with your life. So kind of just thinking through some of the risk-adjusted part of these returns, just looking at a 15 versus a 14 or something like that doesn't always tell you everything you need to do. Maybe the 14 is better off from a global standpoint because you're not taking all these inherent risk, and that's a little bit more likely to hit than maybe the spectrum of outcome might be a little bit wider on some of these tougher or lower experienced sponsor deals. Maybe you make a 20 or maybe you make a 0, who knows, or negative. So thinking through some of those risk-adjusted part of the returns, I think, is what a lot of limited partners that even invest with us, I don't think they really fully realize kind of the risks they're taking with some of these different deals.
Yeah, for sure. Can you, going back to that initial question, can you guys take, for instance, let's say you guys have 50 people in this pool,
Mhm.
and someone says, "Hey, I invested 200,000 and I'm out, and I want to get out." Can you put that back up to, those investors that are already in the deal? Like, hey, if you have, an extra, $50,000, you guys can get
Yep.
in more on this. Have you
Yeah,
guys
the
done
way
something like
our documents generally written, kind of the broad strokes is the manager kind of has the first right to buy them out,
that?
and then
Okay.
after that, it goes to the rest of the members of the group. And if
Yeah.
no one wants to buy it out, then they can then go to a third party and then offer their shares to a third party that's not part of the membership, but it kind of goes in that priority. And typically, we just buy them out if we have the kind of cash ready available and we believe in all our deals. We double down. And that probably, I mean, honestly, with as many deals as many investors we have across as many deals as we have, that's probably something that happens once a quarter for some reason or another. Divorce,
Yeah.
got this, got to buy a house, kids going to college, whatever, died. I mean, you name it. I'm not gonna say I've seen everything, but you see a lot of stuff when you just do enough deals.
Yeah, 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 for sure. And doing those deals and everything like that. Right? Is there, when you're looking in Dallas, Fort Worth, or you're looking in, and I know you guys are, in that bread and butter, B class. Is there anything else that you guys are looking for? Are you guys looking for garden style? Are you guys looking for just a specific number of units? What are the indications for you guys as going into an investment that are for one a no-go, and two, this is a full tilt all in?
Sure. I mean, at this point, we're always been like kind of location sensitive, so trying to stay out of high crime areas, lower socioeconomic areas, kind of that, or AKA the hood, right?
Yeah,
Trying not to
yeah,
go into these tougher high crime areas. Really anymore now, we're buying kind of A minus to A, so stuff that's kind of 20 years or younger. And that's
yeah,
just kind of a function of the way the cap rates are today. Peter, when I started, there used to be Class A deal in Dallas was like a 5 cap, a B deal was like 6.5 cap, and a C deal was like 8 to 8.5. Fast forward today, I mean, they're virtually on top of each other. And
Oh,
Dallas
okay,
Fort Worth is, probably a 4 cap market, if not south of that right now, as we
okay,
record today in May of 2021. And we're like a 4 cap market, which is crazy sounding, but that's like reality. That's real time where it's at. And irrespective of the location, property condition, grade, these cap rates are pretty much on top of each other, probably within 50 basis points, half
okay,
a percent. So you're not really, in today's environment, Michael Becker's opinion, I'm not getting paid to take on a lot of value add and older stuff. You're paying very similar cap rates on at least kind of in place income. So we've been trying to take this opportunity. We've kind of been selling older, smaller stuff, buying newer, bigger, better stuff. So we own anywhere from your kind of traditional garden 2-3 story walk up product, which is a lot of the stuff that kind of is a C and B space, all the way
yeah,
to brand new 5-story wrap products with structured parking, have one podium deals, kind of like underground parking with apartments on top of it. So we kind of span the gamut on kind of the quality of assets that we own. And I'm just really trying to find, the way I think about it is it's a relative business,
yeah,
so if I look at everything and this seems like a relative value to everything else on the marketplace, that's what I'm kind of gravitating to. And recent past, I mean, that's been kind of your A to A minus space. So the value add is a little bit overplayed, in my opinion, in the current environment. You have to overpay so much for the deal to then get the opportunity to go do the value add and hopefully drive a higher IRR. And that's kind of what it's like in the Texas markets. And I think that's
okay,
probably pretty similar in most major metropolitan areas across the country, but that's certainly the case here. So we've taken this opportunity where I think the market is a little bit out of whack and take this opportunity to buy bigger, better, nicer things. And that's kind of been our philosophy: get a little bit better debt quotes and a little bit better quality assets. And that seems to make a little bit more sense from a risk adjusted return standpoint for us, because the returns are relatively similar to maybe something built in the 70s with a lot of deferred maintenance and having to go do a lot of work and actually go execute that upgrade and execute the higher rental rate. So I got a lot more ability to screw that deal up than I do something that kind of is pretty and works from day one.
yeah, yeah, yeah. So those repositions, you guys, are really hands off. But when you first got into it, were the first 2 to 3 years, were
Yeah.
you doing a lot of those?
That's all we did, right? And
Yeah,
that made the most sense to us at the time.
yeah,
But like I said, we were paying 8 caps, and there was a lot more rental rate upside, and these were all kind of 100% classic deals. And now you're looking at those deals a deal that I bought 8 years ago and sold 6 years ago, that then sold, 4 years ago, and then sold 2 years ago, is now back on the market. You're on like version 3.0 or 4.0 with a value add. So now you're value adding a deal that's already been value added 2 times before. So, it just, for me, to be in the business a little bit longer. I mean, it's not been like for forever, but, almost a decade, and the ownership space, and longer before that as banker. Sometimes that's an asset for me, because I got a lot of experience. I kind of just got a sense about myself when I'm looking at deals. I can kind of recall in my mind what this thing traded for in this location, and I'm pretty quick to make a decision. But sometimes that's a detriment to me, because I'm thinking like, well, this deal just traded for 50 a door a couple of years ago, and now they want 100,000 a door, and there's no way in hell I could pay that. But maybe it's a deal at 100,000 a door, and I'm just kind of not even looking any deeper, just because I get sticker shock because I remember what it was. And so like sometimes it helps me, and sometimes it hurts me, and just trying to be realistic about kind of, maybe just because I don't do it doesn't necessarily mean it's not someone else can't find value and make a deal out of it. So it goes both ways.
Yeah. I could see that. So you can have a main acquisition member, right? Or is that?
Sean and I are my partner and I are really kind of that's one thing I don't want to give up, is kind of the acquisitions role over company. That's kind of like one part of the business to me. I'd much rather give up all this other crap I have to do. So I'm trying to hang on to this and get all the other stuff off of my plate.
Okay. All right. And when those come across your table, I mean, they're coming across usually, from brokers that you guys built relationships with, to, are you guys doing, any type of marketing outside of, building those relationships to get those deals done?
Well, most of the deals have a broker involved. The last deal we actually closed on, we did direct with the owner. We actually helped him buy the deal 4 years ago as a client of my partner, Sean, from his former firm. So we kind of stayed in touch. So that happens maybe every 15th deal or so. There's not a 50th or 20th deal. There's not a broker involved, but on market or off market, there's usually a broker involved. And it might be that I know a lot of the people that are kind of in town, or players in town, just being around for, between a banker and a principal, nearly 20 years now. I'm only 42, but I've been doing this my entire professional career, basically. So some form or fashion, and then, kind of knowing some of these people. But usually there's a broker involved, and, known all these guys a very, very long time, because a lot of the guys that are now kind of the prominent people are all around my age, where we used to be the young guys. Now we're kind of like the middle-aged guys have been doing it for a while. And the guys that were the senior guys when I started are now kind of retiring or have a much lesser role. So I got, it's a completely unfair business, like I said. So, a lot of it is, relationships and who and history and people liking you, and you kind of getting, I think about it like on a on-market deal, I want to make sure I get the last call in a deal. On an off-market deal, I want to make sure I get the first call on the deal. So I kind of have, either the last bit of information or the first look at something. So just, how do you angle yourself to get into that position? And, if you're coming into town and you don't own anything, and a lot of people are coming into my town trying to do deals, they got to go up against a guy like me that's got, over a decade of going to various golf tournaments and shooting stuff and fishing and hanging out at the bar and doing all these transactions with these brokers and having all this like personal one-on-one time. You're going to come in cold and compete against a guy like me. I'm definitely going to have an advantage over you just because I got my time in. It's going to be kind of hard. So me going to a new market, I got that same kind of challenge to overcome. And just the way the world is, and you just got to kind of brace that. And I work to try to overcome some of either work your advantage or work to overcome the disadvantage you have, whichever side of the coin you're on.
Yeah, for sure. So what do you see? I mean, you guys looking towards the next, 2, 3, 4 years, what's your plan? What's your model, going towards, the horizon of what the market, continues to do down there? I mean, granted, I know you're bullish, and I'm bullish on it too, in the sense of what the market's doing now. What do you see for your guys' company, what you're going to be doing?
Yeah, I think it's only going one way, hopefully, and that's up. So we're going to keep trying to do more. We're getting our first 2 deals in San Antonio. Dallas-Fort Worth's got about 850,000 market rate apartment units. I think Austin's up to like 225,000. San Antonio is about the same size as Austin. So, we're going to have 1,300,000-ish, 1,400,000-ish units potentially to go out kind of and fish in that pond.
Yeah.
So, we're buying our first 2 deals, 550 units roughly in San Antonio. Love to finish the year off at 1,000 units and try to really get a base. So if you're in for a penny, you need to be in for a pound. So try to really get a good base and hopefully be at 1,000 units in San Antonio, and then kind of just proportionally grow from there. And the 3 markets that we participate in. Austin's extremely challenging to operate in right now to buy. We actually have a deal we're closing in a week in Austin, so I feel real fortunate about that. But it's going to be tough to go out and replicate and get more deals. It's just, extremely, if Dallas is a 4 cap market, maybe a little bit south of that, Austin's probably a 3.5 cap market right now. And that sounds crazy. Those words come out of my mouth, but that's kind of the reality. And I said the market in the country that everyone wants to be in. So for us to have 1,500 units down there, I feel pretty fortunate to have that base down there and relationships down there. But try to get more. I think we're about 6,500 in the portfolio today after we sold some stuff. We're going to sell 2 deals, buy 3 here in the next, say 3 months from now. That's probably what we're trading out in real time. And so you'll probably hopefully finish the year around 7,500 units, hopefully finish 2022 around 10,000 units, and then kind of reassess from that point. So if I could finish, 18 months or so from today, be about 10,000 units in the portfolio, selling a few deals along the way and buying more than I sell, I feel like that's a pretty good win. And then continue to just make sure we just cull the weaker part of the herd and make sure we let the winners run and try to own deals a little bit longer. Because if we would have figured out how to keep those deals that we bought for 30,000 unit that we sold for 50 something thousand unit that are now worth $100,000 a unit today, I'd be a lot richer than I am right now. So that'd be so trying to make sure we keep as much as we can, but still transacting opportunistically on the sales side along the way.
Yeah, for sure. Especially that. I mean, looking at the market being bullish on it and everything, especially going down, in the next couple of years, I feel like, you buy something, even though you value added it 2, 3, 4 years ago, what makes that judgment call actually, even if it's still like a good workhorse and you guys are still having that income coming in, outside of, let's say the investors are still good with keeping it and stuff like that. What makes you decide, and your partner decide like, yeah, I mean, even though this has been solid, we got to get rid of it?
I think if you're cold and calculated about it, if you could sell it for more than what you could buy it for, and you could then take that cash and then, go deploy that in something and get a better return than what it would be just kind of keep on it. That kind of I think makes sense. If you take a $5 million equity base and it grows to 10 or 11 million, and you could take the 10, 11 million and produce more current cash than what you have on your investment, then that probably makes sense to maybe transact. It's, there's transaction costs obviously going in and out. If you go to cash, you got to pay taxes on it along the way.
Yeah.
And if you have a prepayment penalty on your loan, sometimes that eats into it. So you need to kind of take a holistic approach at it. But, if I could go out and produce a materially higher return, all those things kind of take into account, then compared to just kind of keeping what I have, sometimes that makes some sense. But, it's a lot of work to buy and sell. And once it's kind of going and owning it for a little while, I've seen a lot of people make a lot of money just kind of owning these deals for, a decade or two. Yeah. And let I think I believe that we're going to kind of at some point this decade see, material inflation kind of come across our desk, and that should be pretty good for real estate. And a lot of this is I'm going to look really smart, but a lot of this is going to be just be in the right place at the right time with the right asset, and be, inflation come make me look a lot smarter. I have my debt stay here and my value, my property get dragged up.
Yeah.
You do that on nominal basis. We should do pretty good.
Yeah, for sure. No, I agree 100%. Well, Michael, we'll transition a little bit and see if you can answer a couple of questions for the audience. So either, something recent or in the past, 5-10 years, have you read a book that's really helped you, get prepared for, doing some investing, or something that's helped you in growing this business?
I'm not the biggest book reader, but, I'll give the one book I think that I have read that I thought was pretty well written was Tax-Free Wealth, Tom Wheelwright. So just kind of taking some of the principles that he laid out in his book and applying some ways you can set up your structure and your life to be, pretty efficient from a taxation standpoint. So we're constantly trying to make sure that we're as efficient as possible from a taxation standpoint, both from income tax as well as now kind of fortunately making sure that you get kind of your estate tax set up and how all that stuff kind of interchanges with each other. That's a big part of if you can keep more of your money and not pay it in taxes, you can compound this stuff even quicker. So I think that was a pretty well written book, and there's a lot of talking points I took, and then took that to my tax professionals, and then apply those principles in my day-to-day life.
Yeah, for sure. I think that's Robert Kiyosaki's like group.
It is.
Yeah. Yep. So I read that one. That one's good. And then any type of software tools that you guys are using in your business that are making you, more efficient on a day-to-day basis?
My favorite thing that we use is relatively simple. It's Dropbox. It's been the greatest thing that we have. And, I think one of the best things we've done is we really got, we first started, we had Dropbox, but we had the file folder for each one of our deals or whatever, but it was kind of a little bit disorganized. So several years ago, I was really frustrated because I would go try to find a closing statement, and this one folder would be in this one subfolder, and this other folder would be somewhere else, and I'd spend 5 or 10 minutes hunting for something. Well, a few years ago, we just got an organized chart of accounts, basically, or a file folder system. So every one of our deals are set up identical, and everything's stored in an identical name folder. So that having a consistent naming system within Dropbox, I can go find anything at any time from my phone or my desktop. I don't burn 10, 15 minutes here and there trying to go hunt it down. And so that's been having a uniform naming and organized system. It's been great. So that's a really simple thing, but you didn't quite think about that when we started getting it kind of set up functionally the right way from the beginning. Would be something I would highly encourage people to do, because if you grow and scale, you need to make sure everything's consistent. You got a bunch of different people across your company trying to find this information. It needs to be efficient along the way.
Yeah, for sure. I think you and I are both the same. Well, I mean, I'm not saying that you put the Dropbox in a different, section, but I've done that before where there's been like, multiple things where I'm like, I know I've saved it here, but it takes you 10 or 15, 20 minutes to find it. And you're like, man, I could be doing something else with my time right now, but I'm searching and digging for this thing that I need right now.
That's right. And the more successful you get, the more your time's worth. So burning 15 minutes on something, that's at the expense of making money doing something else.
Yeah, for sure. Well, Michael, where can people find out about you and your company?
Yeah, there's I'll give 2 resources. Some of the co-hosts of the Old Capital Real Estate Investing podcast. So you can find that on iTunes or Stitcher, or probably anywhere you hear my voice, or our website's www.oldcapitalpodcast.com. So we've been doing that for several years. So certainly encourage people, if you listen to this or you're this far into this podcast, you're probably an apartment nerd and into apartment. So I'd encourage you to check our show out. Our company that I run is SPI Advisory. You kind of see that behind me here. Yeah. So SPI Advisory, you go to our website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form. Fill that out. We'll always have to have send out some information about potentially working with us or potentially investing alongside of us. Looking forward to more and more deals in the Texas markets, and really bullish about the future. So appreciate anyone that's interested to reach out.
Yeah, for sure. Well, Michael, thank you so much. It's been, it's a lot of information, especially when, you have someone who does syndication, also builds these deals, and it's not like a single family residence, where you're just buying one at a time. So super helpful and enlightening talking to you.
Yeah. Thanks for having me on, Peter.
Yeah, of course. Thanks.